It looks to me that there's a run on gold, physical gold, and I guess we can speculate why. It could be, the Treasury needs to do an audit of its gold, and a lot of it left, so they need to bring it back. Or investors are just concerned about all the uncertainty, geopolitical, trade wars, and whatever, and the possibility of even a major war. I don't like talking about the Third World War, but President Trump even mentioned it when he was having a chat with Zelensky the other day. He said, you're going to, trigger World War III. During war or major conflicts, nobody accepts paper. Countries need gold to pay for their war efforts.
Gold flows from London to the United States have been notably significant since the start of the year, with millions of ounces being transferred. This trend has sparked attention as it deviates from the usual patterns in the global gold market. Reports highlight large volumes of gold leaving London vaults and heading to the US, leading to speculation about the driving factors behind this shift. Some analysts suggest it may result from price arbitrage opportunities, where differences in gold prices between markets create favorable conditions for large-scale transfers. Other theories point to the possibility of the U.S. repatriating gold reserves to consolidate national holdings, especially given the current market conditions. In addition to the movement of gold, there have been significant delays in gold deliveries from the London Bullion Market Association (LBMA), raising concerns. Typically, spot delivery would occur within 2 to 3 days. However, these timelines have stretched to 4 to 8 weeks. This extension of delivery times has raised alarms about the stability and functionality of the gold market infrastructure. Mario Innecco has noted that the growing delays in gold deliveries indicate a significant issue within the LBMA's structure. He highlights that the problem may not lie with missing gold, but with the over-reliance on paper gold, which distorts the reality of available physical reserves. The system has increasingly relied on trading paper gold contracts, meaning that the gold exchanged on paper doesn't necessarily match the actual gold held in reserves. This disparity between the paper market and physical gold holdings has now been exposed, raising questions about the market's long-term stability. Innecco suggests that this structural weakness, particularly in fractional reserve gold trading, is a major concern. We present the clips of Mario's insights from his recent video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I guess it's been going on since I think mid-November or sometime in December, and we only really learned about the problem on the LBMA or in the London Bullion Market back in January 29th, when an FT report or article came out and said that the spot delivery had been extended to from up to 4 to 8 weeks. So instead of T plus like 2 or 3 days, 4 to 8 weeks. So there's definitely something wrong there. And yes, I reported on that right when that came out. I thought it was really significant. And I'm not trying to brag, but I said at the time that it was the most important development in the gold market, maybe since Gordon Brown pre-announced the sale of half the UK's gold back in 1999. Yeah, and from what I know, the delivery on the LBMA and the London vaults is still delayed. And I think, Elijah, it just shows that there's a de facto default right now. And I'm not saying there isn't any gold there. I think it's just the way they rehypothecate, or they fractional reserve gold, or they trade paper gold, is basically kind of been exposed. Maybe not because people have been talking about it like I have and many others, but because for some reason, someone in the U.S., we can speculate who that is, Someone wants the physical, and they don't want just the physical in the vaults, like or through the EFP, which is like a mechanism to trade between COMEX and the LBMA. And EFP stands for exchange for physical. But when I worked in the futures market, I can tell you that when my colleagues did EFPs, I wasn't too involved in that. It didn't mean physical. It just meant another paper scheme. But now the people, whoever's taking the gold in the U.S., they want it out of the LBMA vaults. They want it into COMEX and out of the COMEX vault, because a lot of deliveries on COMEX prior to now were just done through the vaults. You just change, it's going to go from account A to account B, but the gold itself had always stayed there. So it looks to me that there's a run on gold, physical gold, and I guess we can speculate why. It could be, the Treasury needs to do an audit of its gold, and a lot of it left, so they need to bring it back. Or investors are just concerned about all the uncertainty, geopolitical, trade wars, and whatever, and the possibility of even a major war. I don't like talking about the Third World War, but President Trump even mentioned it when he was having a chat with Zelensky the other day. He said, you're going to, trigger World War III. And from what I've learned and studied in the past about gold, and Alan Greenspan once said that during war or major conflicts, nobody accepts paper. Countries need gold to pay for their war effort.
According to Mario Innecco, one of the major factors driving the price of gold is the rising demand for gold reserves from central banks, particularly within the BRICS nations. Notably, China's central bank has increased its gold holdings for the fourth consecutive month in February. According to recent data, the People's Bank of China added 0.16 million troy ounces to its gold reserves, signaling the continuation of a deliberate strategy to diversify its financial assets. After a 6-month pause in its gold purchases, this move marks a return to a pattern of steady accumulation, which had been a key feature of China's monetary policy for nearly 2 years prior. Innecco argues that these central banks' growing emphasis on gold represents a strategic effort to reduce their dependence on the US dollar. This shift is particularly evident among BRICS nations seeking to strengthen their economic sovereignty by bolstering their gold reserves. As these nations aim to mitigate risks associated with the dollar's global dominance, the accumulation of gold acts as a hedge against currency volatility. This trend will likely impact global gold prices as increased demand from central banks drives up the market value of the precious metal.
I mean, if we go back the last 3 years, the big money, i.e. the major central banks and governments of the world, like especially the BRICS and BRICS-aligned countries, they've been buying the most net gold since the beginning of the Bretton Woods agreement in 1944, 2022, 2023, 2024, record amounts. And I think personally, there is a probability that U.S. Treasury is coming, new Treasury, new administration, and they know about this. We've seen Marco Rubio, prior to him becoming Secretary of State, say that the BRICS are not going to use the dollar. The Treasury Secretary, in an interview prior to even the election, Scott Bessent, he said that he expects Bretton Woods-like realignment. What does that mean? Well, it means that we're going to have a new monetary conference amongst the major powers of the world, just like we had towards the end of World War II. And whenever there's a realignment, monetary realignment, it means that the old system is dying. So the current system, or the old system, is the fiat debt-based dollar. And and now, so it could be I think it's a good chance that it is the Treasury bringing back its physical gold. but it could also be very heavy hitters out there. One case in point being Warren Buffett, whose company Berkshire Hathaway has $334 billion in cash, and I saw that in his recent recent letter to his shareholders at the end of the year. For 2024, it came out about a week ago. He said that paper money is always, you can't trust paper money nor government bonds. That's what he said. And I think that was very telling, despite the fact that he's holding a lot of the $334 billion in cash and treasury bills. Yeah, and of course, he has said in the past that gold, you mine it, you bring it out of the ground, and then you refine it and turn it into bars or coins, and then you put it. His father was a congressman from Nebraska, and he was a sound money advocate. So I'm sure Warren Buffett knows about gold. So yeah, as for the small investors, they're still asleep at the switch, except the people that watch our channels. I would say they've been awake for many years. But now maybe you could be right. They could be starting to look for alternatives. And why do I say that? Well, because it looks like the general stock market is starting to keel over. And I remember when I bought gold for the first time in '02, the reason I did it is because I sat down with my wife and looked at my private pension, which hadn't done well after the dot-com bubble burst. Not because it was invested in the dot-com bubble stocks, but all the stock market suffered. And for some reason, we said, why don't we buy a little bit of gold to diversify? So yeah, we could be close to that. And that's how I see it.
Gold prices are expected to continue their upward trajectory, with the metal approaching annual highs in the near future. Economic and political uncertainties and rising demand from investors seeking safe havens are anticipated to drive prices higher through 2026. While Q1 2025 is expected to see a strong performance for gold due to seasonality and ongoing geopolitical instability, however, this correction is expected to be short-lived, with gold poised to rebound as economic pressures intensify. One of the key factors supporting gold's rise is the increasing accumulation of gold reserves by central banks, particularly in emerging economies. Many countries, especially within the BRICS nations, are strategically diversifying away from the US dollar by bolstering their gold holdings. This trend has gained momentum as central banks seek to protect themselves from geopolitical risks and potential financial instability. As these nations accumulate gold, the demand for the precious metal is expected to remain strong, providing further upward pressure on gold prices in the coming years. That's it for today. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video.